Nvidia's in the spotlight again as AI stocks rise. But what if the next big investment opportunity is hiding in plain sight? As global demand increases and export rules shift, a quiet struggle is developing, not just among the major players, but also with new competitors entering the market. Today, we're breaking down AMD and three other emerging tech AI chipmakers that could surge as the market shifts. Some are losing ground, others are quietly scaling, forming key partnerships, and tapping into overlooked revenue streams. To celebrate reaching 1,000 subscribers, we're offering a free guide that explains how top investors identify breakout stocks. Check the link in the description. If you find value in this video, please like, share, and subscribe so you don't miss out. And remember, this isn't financial advice. It's for educational and informational purposes only. Always do your research. Investing involves risk and speculation. Thank you. All right, starting with Intel ticker symbol INTC, the company has been steadily maneuvering behind the scenes, determined not to be left behind. The tech giant, with a market cap just shy of $100 billion, has seen better days. Its stock is down nearly 34% over the past 12 months, far underperforming both the broader S&P 500 and the XLK Tech Index. But don't count Intel out just yet, because what's happening beneath the surface could set the stage for a sharp reversal. With Q2 fiscal 2025 earnings due July 24th, Wall Street is bracing for a modest headline, a projected loss of 14 cents per share, flat from the same quarter last year. But that alone doesn't tell the whole story. Zooming out, Intel's fundamentals are showing signs of life. Analysts expect the company's losses to shrink by nearly 65% this year, and EPS to rebound by 150% in fiscal 2026. That shift could reframe investor sentiment, especially if earnings come in stronger than expected. With the stock trading around $23.10, Nvidia's fundamentals could shift the bearish narrative. Technically, Intel's chart is tightening. It's bounced sharply from the $19 to $20 zone, forming what some analysts view as an accumulation base. With resistance at $25, a clean breakout could open the door to $27.30 in the short term. On the flip side, a drop below $20 would be a red flag, signaling a potential return to weakness. Now, let's talk macro. As U.S. chip export controls tighten, especially with restrictions on sales to China, Intel finds itself at a critical inflection point. While Nvidia dominates the high-end AI GPU market, Intel is doubling down on custom silicon, mission-critical compute, and advanced server infrastructure. Its newly launched Xeon 6 processors, built for high-performance, memory-intensive workloads, are CXL 2.0 ready, aiming squarely at AI, in-memory databases, and next-gen simulations. These moves signal Intel's intention not to chase Nvidia head-on, but to own adjacent categories where AI infrastructure still lacks depth. Moreover, the Intel Foundry push, the company's strategic foray into contract manufacturing, may help Intel reposition itself in a post-globalization chip landscape. As the U.S. reshuffles its semiconductor supply chain, Intel's domestic foundries may become more attractive for both government and enterprise clients seeking reliable, tariff-free alternatives to Asia-based fabs. Despite this pivot, Wall Street remains cautious. Out of 38 analysts, 32 have a hold rating, while just one suggests a strong buy. But here's where it gets interesting. While Intel currently trades above its mean price target of $22.88, there's a street-high target of $62, a bold 171% upside from today's levels. If Intel delivers a narrative-changing earnings surprise or lands a key AI contract, that target may not be as far-fetched as it sounds. Intel may not be the flashiest chip stock in the race for AI dominance, but don't confuse quiet with stagnant. The company is actively reshaping its strategy, narrowing losses, rolling out competitive products, and leveraging U.S. manufacturing tailwinds to remain a key player in the semiconductor chessboard. With earnings on the horizon and short interest still high, INTC could be gearing up for a catalyst-driven move. For investors with a high risk tolerance and an eye for turnaround plays, this may be a story worth watching. Do you consider this stock as one with potential opportunities? Let us know. All right, moving to the following stock. Advanced Micro Devices AMD is quietly positioning itself as a serious contender in the AI space. Trading at $156.99, the stock has gained 185% over the past 5 years and is now approaching the key $160–170 resistance zone, a ceiling it has failed to break since 2022. If AMD breaks through that level with significant volume, it could aim for $100 to $200, but failure to do so might lead to a pullback toward the $130 to $140 or $120 to $130 support zones. AI demand is AMD's growth engine. Its MI300X accelerators are gaining adoption among tech giants such as Microsoft, Meta, and Oracle, with CEO Lisa Su projecting $4 billion in AI revenue for 2024. That makes AMD the preferred diversification option for investors seeking alternatives to Nvidia. Still, headwinds remain. U.S. export restrictions on China affect all chip makers except Nvidia, which has just received U.S. approval to resume exporting its H20 AI chips to China, following a ban imposed earlier in 2025 under export controls. Additionally, AMD's customized, lower-spec products may not fully counteract future regulatory changes. Meanwhile, Intel is adjusting its AI roadmap, and Nvidia continues to dominate the space. Technically, AMD is showing strength, but the real test is whether it can break out or hold its position amid market pressure. For investors, the next move depends on monitoring this key inflection point and being prepared before the crowd reacts. What is your take on AMD stock? Buying at the current market price, holding, or selling? Drop your comment. The next stock that has the potential to 2x your capital is Marvell Technology, ticker symbol MRVL. With a market capitalization of roughly $64 billion, the company has transitioned from a networking specialist to a core player in artificial intelligence and cloud infrastructure. While the stock has delivered a negative year-to-date return of 32.25%, it maintains a positive one-year return of 9.80%, with volatility reflecting broader sector swings rather than fundamental weakness. In the first quarter of fiscal year 2026, Marvell reported a 63% year-over-year revenue increase, fueled by surging demand in AI-focused data centers and enterprise cloud deployments. Its portfolio of custom application-specific integrated circuits and data processing unit products, including the ThunderX line and Octeon processors, has attracted enterprise-scale clients such as Microsoft's Azure platform. Acquisitions like Inphi and Cavium have further cemented its position in high-growth areas, such as 5G and cloud storage. The U.S. government's decision to allow Nvidia and AMD to resume exporting advanced AI chips like the H20 to China is also likely to boost Marvell's prospects by accelerating international AI deployments that rely heavily on Marvell's interconnect, switching, and storage solutions. From an investor standpoint, Marvell's fundamentals point toward long-term growth, while its technicals provide a disciplined framework for decision-making. Marvell currently trades around $75 per share, sitting in the middle of a well-defined trading range shaped by technical support and resistance zones, with the $68 to $72 range acting as an accumulation zone where institutional buying patterns, evident through volume spikes, suggest long-term investors are willing to build positions during dips on confidence in the durability of AI and 5G-driven demand. The $75 to $90 range serving as a holding zone for investors already positioned, as it reflects ongoing momentum while allowing flexibility to add if earnings confirm accelerating revenue growth. And the $100 to $120 range functioning as a profit-taking zone, historically a region of consolidation and resistance where disciplined investors may secure gains unless catalysts such as blockbuster earnings or major contract announcements trigger a decisive breakout, with sentiment supported by Marvell's rapid top-line growth, diversified portfolio, and position as an infrastructure provider insulated from consumer-driven cyclicality, making it a preferred choice among institutional investors seeking AI exposure without the inflated valuations tied to GPU-centric peers. Marvell represents a unique way to capture the infrastructure-level growth from AI and cloud expansion. Its combination of accelerating revenue, exposure to enterprise AI buildouts, and clearly defined entry and exit levels make it an attractive consideration for growth-oriented investors seeking disciplined participation in the semiconductor sector. This brings us to the last stock. Qualcomm, trading under the ticker QCOM, with a market capitalization of approximately $169 billion, has extended its influence well beyond smartphones to become a key player in 5G networks, automotive technologies, Internet of Things, and edge artificial intelligence. Although it has posted a positive year-to-date return of 1.92%, the stock remains up 86.72% over the past years, underscoring its resilience and diversified revenue streams. In 2024, Qualcomm generated about $39 billion in revenue, an 8.8% increase year over year, while net income jumped 40% to $10.1 billion, fueled by handset licensing, premium smartphone chips, and rapid growth in automotive and IoT segments. Strategically, Qualcomm's acquisitions of Movian AI and AlphaWave IP reinforce its ambitions in AI inference, cloud integration, and edge processing, further diversifying its earnings beyond mobile. The recent U.S. approval for Nvidia and AMD to export AI chips to China indirectly benefits Qualcomm by improving trade sentiment and supporting demand across smartphones, IoT devices, and connected automotive markets where Qualcomm maintains a substantial footprint. For investors, Qualcomm's balance of growth and technical stability supports a calculated approach. Trading near $155 per share, Qualcomm currently sits at the center of a well-defined technical channel, with support in the $140 to $150 range and resistance between $185 and $200, aligning with recent 52-week highs and key psychological price levels. The $140 to $150 range serves as a strategic accumulation zone, as it has consistently acted as a floor during pullbacks, supported by institutional buying evident in volume surges near the lower band. The $155 to $175 range functions as a holding zone, where existing investors can maintain positions while Qualcomm's automotive and artificial intelligence segments increasingly drive revenue, offering stability and balancing short-term consolidation with medium-term confidence. The $185 to $200 range represents a logical profit-taking zone for short-term traders and disciplined investors, as this level coincides with historical resistance, and would likely require a significant catalyst, such as earnings results surpassing expectations or major partnership announcements to break through convincingly. From a sentiment standpoint, Qualcomm's robust earnings growth, diversification across key technology sectors, and alignment with long-term trends like AI and 5G continue to offset broader sector volatility, maintaining steady investor interest even as the stock consolidates. Qualcomm offers investors a way to gain exposure to AI and connectivity growth across devices, vehicles, and edge computing. Remember, this content is for informational and educational purposes only and does not constitute financial advice or a recommendation to buy or sell any securities. Investing in the stock market involves risk, and past performance is not indicative of future results. Viewers should conduct their own research or consult with a licensed financial advisor before making investment decisions. Which of these four AI tech stocks are buying, selling, or holding? Share your thoughts in the comment section. If you find value in this content, please like, share, and subscribe to this channel. See you in the next video.